Hello. Today we're going to discuss a few options for saving for your child's college expenses, and specifically the key differences between a 529 plan and a high cash value whole life policy. A 529 plan can be a valuable tool for saving for education, but it also has its own drawbacks. Here are some pros and cons to consider. Tax benefits. Some states offer tax deductions or credits for contributions made to a 529 plan, but the few that do typically have a limit, and there is no federal tax deduction for any contribution. Contributions are made with after-tax funds, but the main tax benefit is they grow tax-deferred, and then all withdrawals for qualified education expenses are tax-free. Many states allow for a high contribution limit per child. However, if you exceed more than the federal annual gift exemption, which is $19,000 in 2025, you will have a bill ranging from 18 to 40% of the contribution that exceeds that limit. You do have some flexibility. The funds can be used for a variety of educational expenses, including college tuition, room and board, books, and even K through 12 education in some cases. You also have some investment flexibility, but of course, you are limited with every plan's investment options. And you do have some control. The account owner retains control of the funds and the investments and can change the beneficiary to another family member if needed. But what if? What if there's a market downturn before or during college? Potential market losses can wipe out or reduce your account and financially derail your child's goals. Be sure to watch my video on sequence of risk to see the difference of market volatility between a growth phase or a withdrawal phase for any reason. What if your child decides not to go to college? There are penalties for non-qualified withdrawals. If funds are used for non-educational expenses, all withdrawals are subject to income tax, as well as a 10% penalty. If the child decides not to go to college, and there are no other children to pass the gift to, a new tax rule allows the rollover into a Roth IRA for the child. However, the account must be at least 15 years old. The child or beneficiary must have earned income that equals the amount to be rolled over, and the rollovers cannot exceed $7,000 per year under current tax laws. And with most qualified plans, the funds cannot be distributed until the child is 59 and a half without a penalty. What if your child needs financial aid above and beyond the 529 plan? All 529 plan assets are considered in financial aid calculations, which could reduce the eligibility for need-based aid. So how does this compare with a whole life policy? The contributions are similar to a 529, meaning all are after-tax contributions, and they grow tax-deferred. But unlike a 529, the cash value can be used tax-free for any purpose, and there are several living benefits as well as the death benefit that pass to beneficiaries completely tax-free. They have a very high contribution limit. There is no contribution limit. Policy sizes are only limited by income and suitability requirements. There is a lot more flexibility. The policy funds can be used for anything at any time, and you have a lot more control. The policy owner retains control over the funds and can change the beneficiary to any family member for any reason. And whole life has no market risk. You have a guaranteed rate of return plus dividends, so you can rest assured that a market loss will never derail yours or your child's goals. There is no penalty for qualified withdrawals. The funds can be used tax-free for any purpose. There are no penalties for non-qualified withdrawals if your child changes plans. And whole life does not impact the FAFSA financial aid calculations, and it will not affect eligibility for any need-based aid. So now you know, saving in a whole life insurance policies offer a lot of advantages over a 529 plan. One of the main key benefits is the guaranteed cash value growth, which can provide a stable financial resource. A whole life policy can be accessed for various needs, not just education. Where 529 plans are primarily intended for educational purposes only and may incur penalties if funds are not used for qualifying expenses. Whole life policies offer lifelong benefits and provide flexibility for wherever life takes your child, whether that be going to college, starting a business, starting a family of their own, and they continue to offer benefits long after college. Contact my team and I for more information. We would love to discuss with you.